Phil, thanks so much for being with us.
My pleasure, Betty.
And you say it's just a whole lot of nothing. People talking about whether or not this market's going to correct.
Well, I mean, you're going to have some negative surprises. My guess is the strength of the market's going to be held by an economic recovery and earnings that could be much better than people expect. I think you'll eventually see a revenue increase begin in the fourth quarter, first quarter next year.
Phil, you're somebody who talks about this equity rally or this bull rally getting no respect. There's a lot of people who've been citing the Dangerfield effect here after the run-up we've already seen. What is it ultimately that people should be optimistic about in the face of everything we've been talking about this morning?
Well, I think people would do well to get a little history lesson in that basically, historically, the stock market has delivered about a 9.4% return historically. Bonds have been 5, inflation's been 3. Whenever you have periods where the market is underperformed for as long as a decade, normally the next 10 years is great. The historical average is the worst case is you make 7% the next 10 years. The best case is 15%. So my guess is you've got a reversion to the mean story. You've got quality equities trading at a very attractive price. I think it's an ideal time to do exactly what people don't want to do, and that's be an owner. I mean, owning something in anticipation of an economic recovery and earnings recovery is how it's best played out. And my guess is most people are approaching it from a rental standpoint. They're trying to preserve any wealth they have rather than create it.
You know, Phil, it's Adam. It almost argues for just indexing yourself, whether it's going out and buying a Vanguard fund or you know, possibly just buying SPYs or Qs and holding them as opposed to trying to pick specific stocks. Is that the case? Is that the call?
Well, we always forget that in a bull market, people want to own the 100-proof best asset. And I think the ironic thing about this recovery is that there are leaders in healthcare, technology, industrials, the absolute leaders with the best legs in the group trading for historically low valuations. So I think you can do fine in an index. I think the big difference this time around is going to be people are going to want to own the leaders, and the leaders trade at attractive prices. And I think the key is going to be owning them, not renting them.
The leaders, though, driven by what? By their earnings, Phil?
Well, if you look at business models, you can pretty much predict those companies that are going to come out of this thing in better shape than their competitors. And by and large, that's what you see. Tremendous cash. You see companies investing for the future. You see companies investing for their brand, so they end up continuing to take share throughout the decline, and then into the recovery, they come out with afterburners on. So my guess is that this is one of those times when you'd be best served to try to buy the best company in an industry, or best couple of companies in an industry. And I happen to like industrials, I like energy, I like technology.